I want to consider why liquidity is very important in penny stock trading, why liquidity matters in trading penny stocks. This is what every investor or every trader should be conversant with. Liquidity plays a crucial role in penny stock trading, impacting the ease and the cost of entering or exiting positions. So here is why liquidity is so important when dealing with penny stocks. Number one is ease of buying and selling. The ease of buying and selling, it promotes easy transaction in the given stock. There's a quick transaction. High liquidity means you can buy or sell shares quickly without significantly affecting the price of the stock. Not only that, there's smaller price fluctuation. With better liquidity, price tends to be more stable, reducing the risk of large unexpected price movements when executing trade, particularly if the volume is quite high. So you could transact in very high volume without significantly affecting the price of the stock. Number two is narrower bid-ask spread. The bid-ask spread is somewhat narrow. So in this case, it incurs lower transaction costs. So penny stocks have, with liquidity, typically have a narrow bid-ask spread, meaning the difference between the buying and the selling price is smaller. When we talk about bid-ask, you're talking about buying and selling. So the difference between the selling and the buying price is somewhat is smaller. The smaller, the better, because if it is small, it will not really incur much. It will reduce the overall cost of buying or selling the stock. Not only that, there's more accurate pricing. A narrow spread reflects a more balanced market, providing a more accurate reflection of the stock's value. Number three is a lower slippage. So minimize price changes. Slippage occurs when the price of a stock changes between the time you place an order to when the order is eventually executed. High liquidity help minimize slippage, ensuring your trades are executed close to your desired price. But if there is no sufficient liquidity, you may place a trade at, let's say, $3. You may end up buying at $3.70 or even $4. All right, because this issue of slippage. Slippage essentially means the difference between the price you buy a stock, to the price that was really there before you key in your order. All right, that's what slippage is all about. And so not only that, there's more control over execution. There's more control over execution. In illiquid stocks, a single trade can cause significant price changes, leading to unfavorable execution prices. So with higher liquidity, trade can be executed close to the market price. So usually the higher the liquidity, the more you get to buy or sell at a price that is acceptable and comfortable to you. And only that, number four is increased market depth. Increase market depth. So in this case, there's larger order capacity. There's a capacity to be able to bear or to carry larger order. Larger order. So liquid stocks can accommodate large orders without significantly affecting the price. This is important if you plan to buy or sell large quantities of shares without causing undesirable price movements in the stock. There's also improved order matching. So a deeper market with more participants allow a better matching of buy and sell orders, reducing the chances of orders going unfulfilled or delayed. In this respect, in this aspect, you have sufficient number of sellers and sufficient number of buyers. So if you execute, a buy mandate, you are rest assured that your mandate will be filled. Okay, you will not really have you will not encounter a problem where you don't have sufficient, there's no sufficient stock to fill your order. No, and you want to sell your stock, you discover that there's sufficient buyers that could accommodate your order without anything left behind. So sufficient capacity to buy and to sell in the market. There's number five is reduced volatility. Reduced volatility. So in this case, you have price stability. Stock with high liquidity are generally less prone to erratic price swings. They are somewhat stable compared to their illiquid peers, which are common in liquid stocks. In illiquid stocks, this can reduce the emotional stress of price fluctuation when trading penny stocks. You discover that with stability, you discover that you don't really have much stress because you can always have your orders executed even at the price you so desired. Not only that, there's less vulnerability to manipulation. So, and in liquid markets, large price swings are less likely to occur. They're not really common, due to manipulation of large, single trades. In contrast, illiquid penny stocks can be more easily influenced by small amount of capital. Discover that if you key in, a large volume, it might distort, it might distort the stock price, significantly. Please like this video and subscribe to this channel if you've not done that. Number 6 is investor confidence. In this case, there's transparency. Liquidity improves market transparency as price movement becomes more, reflective of the overall market condition. This market efficiency in this aspect. High liquidity generally signals investor confidence in the stock. People are willing to buy and are willing to sell the stocks. That's an indication of confidence in the given stock. So there's an easier to exit position. It's easier for you to exit a position. You want to sell, you could do that very easily because you have sufficient buyers available to pick up, your order. Number 7 is avoiding pump and dump scheme. So pump and dump is it's a fraudulent scheme that individuals use in the markets to manipulate the market. So there's a reduced market manipulation risk, and there's also greater market integrity. There's that integrity in the markets. A stock with high liquidity tends to have a broader base of investors and market makers, making it more difficult for bad actors to control or to conspire to control the price, to control prices. Number 8 is better long-term investment potentials. Better long-term investment potentials. So in this case, there's sustainable growth. Stock with consistent liquidity are generally backed by more, substantial companies or those with greater growth potential, offering better long-term investment opportunities. And not only that, there's less risk of sudden losses. And so you can enter and exit position with more flexibility, reducing the risk of sudden losses due to unexpected price move or lack of market participants. And in conclusion, liquidity is vital. It's a vital factor when trading penny stocks. Very important, particularly when it comes to penny stock trading. You need liquidity, so it directly, affects, your ability to execute trades effectively. and you could equally minimize cost and manage risk, and always prioritize liquidity when choosing penny stocks to trade, as it allows you to better control your trades and avoid unnecessary unnecessary cost and unnecessary volatility.